Hello, my name is Mitchell Joseph. Welcome to Trading the Markets edition. In this class, we're going to talk about a little bit of news events and the state of the market and how to better prepare and also how to actually trade and execute. So let's get into it. All right. So I just want to start off real quick by just doing a quick rundown on SPY. Hold on. Make sure everybody's in here. Yeah, I'm gonna do a quick recap on the day and then go over some news and stuff and then take it from there. So as you guys know, this is the S&P 500. I've been watching this forever. Every day I trade, I have to look at this because it's the market. So when you trade, you look at this and you make sure that you're in correlation with the market. All right. So these are some of my lines. As you notice, the market has been trading this channel for a while. It's pretty remarkable now that after Friday's big candle, we found some continuation today. And now we're closing at the highs of last week, or should I say 2 weeks ago, well, a couple weeks ago. And we're in a position where we actually broke that high and we may go into this territory where we may reach 380s and 390 at a critical level. But the interesting thing is you see today, you see that there's wicks on both the top and bottom. So if we go intraday, you'll see that it actually was back and forth today. So this is the 15-minute. So this is the beginning of the day. You see 8:30. We opened at 375.82. You see we even went up as high as 377. You know, even this first candle was very choppy. Like if I break it down to 5 minutes, you guys can see more detail just how up and down today was, you know. But once we came down and to 373, we were kind of off to the races. We broke high of day and we made a new high of day, and now we're closing around the high. So that's just to show you what kind of day today was. All right. Now what's interesting, very, very interesting, is if you look at the VIX, normally when the market goes up, the VIX goes down. But look at this. The VIX didn't really go down like that. It actually came up higher. It wasn't until the end of the day that it closed. But you notice that it closed higher than it was yesterday, you know. And if you notice on the SPY, we closed lower. I mean, we closed, so yesterday was lower than today, so we closed higher, right? But the VIX should have closed lower because it's supposed to be an inverse, supposed to be opposite. But when you look at it, it closed higher than yesterday. So the VIX is not cooperating. So let me just go into certain events that will tie this together. All right. So one thing to note is that China really plunged today. Objective. So if you guys look at China, you'll see all these top Chinese companies, they lost about $115 billion today. You know, with the government was tightening China and the market just dropped. But what I was saying was this, this is showing that this is the VIX. So all these arrows right here, it's showing every time that the VIX closes with the market instead of opposite of the market. So this is just in October. It's happened 4 times already. So this is already showing you that volatility is lagging across the board. And that also shows you that people are starting to become more hopeful. Well, people are still, I could say people are not sure exactly what they want to do, because you would expect them to become more hopeful, but there's still some people that are like having reservations back and forth and such. Can I get somebody to read this first paragraph? Any readers?
I can read it.
Thanks.
Key's earnings from the morning will provide direction. Clues on the economy will be big drivers, and watch for currencies and bond reactions.
Yes. So this week is earnings. This week is very, very big earnings. So if you guys know, 4 out of 5 the biggest stocks in the market have earnings this week. So later on, so the top stocks in the market are Apple, Microsoft, Amazon. You can throw Tesla in there and maybe Nvidia, but basically the top stocks are having earnings. So depending on what happens to them, they can really move the direction of the market. So it's all about earnings. So this is just a list of certain companies that have earnings tomorrow. So you got UPS, Coca-Cola, General Motors, Cleveland Cliffs, Halliburton, General Electric, 3Ms. These are all JetBlue. These are all big companies. Raytheon. You guys might know some of these companies. So they're having big earnings tomorrow. And depending on what they do, especially UPS, Coca-Cola, GM, it's really gonna move the market. All right. Anybody mind reading the rest of this?
Okay, can you hear me?
Yep, I can hear you.
Okay, I'll read.
Thank you.
The UK made moves today, but it seems like we won't know what's good till the yen normalizes a little. China is a big focus today. I'm looking for a lagging effect due to the earnings, but this will be an area of the market to watch this week.
Yeah, so if you look at the UK, so they're trying to get the yen to normalize, because if you guys have been noticing, the yen has been plummeting. Let me show you guys. If I go to US, so all right, so if I go to USD JPY, this is showing that it's going up, but this is the dollar over the yen. So this is showing that the dollar is going up against the yen. But now if I flip it, I'm going to see what the yen is doing against the dollar, which is going to show you the actual state of the yen. So all you do is you flip it. Instead of USD first, we're going to write JPY, USD. You're going to see an opposite chart. You're going to see a totally opposite chart. Hold on, let me let some people in. Oh, I think they already left. All right, but but like I was saying, you're gonna see a totally opposite chart. JPY, USD. You guys see that? So this is the yen. And this is a problem because it's interesting though, because Japan's economy thrives off their money becoming weaker, so that when they trade, they get to pay less. But they rely more on exporting, but since we rely more on importing, we want our money to be stronger, so that when we go to their country, so when they pay for our stuff, they pay more. Does that make sense to you guys? Any questions? So they're basically waiting for the yen to normalize and find some kind of stability. Let me just let somebody in. So they're basically waiting for the yen to normalize and find some stability, because if you notice, it's been going straight down, like straight down. Yeah, there's little areas of consolidation here and there, but it's not really normalizing. So until this normalizes, it's definitely going to affect the macros when it comes to the Great Britain pound. So another example, this is the Great Britain pound. If you notice, this hasn't been selling off, but it has recently kind of been trying to do something. But as you can see, it also sold off really hard. And if you know anything, the Britain pound, this was the strongest European economy currency that actually held up. And now it broken down so much that it's really throwing a lot of things into disarray. So back to this is basically saying the UK made moves today, but we won't know what's really happening until the yen actually finds some stability, because these currencies affect the dollar. And if we look at the dollar today, DXY, we see that the dollar actually is coming down, and the dollar coming down is helping other things go up. So understand, when the dollar goes up, it takes money out of every single asset class. So real estate suffers, stocks suffer, currency stuff suffer. So right now the dollar is actually cooling off. It's helping everything else actually bounce a little. But like I was saying earlier, if you look at the VIX, it is not cooperating. The market went up today and the VIX closed up today. This has happened about 4 times. So this is really showing you that volatility. So basically the full effect of what's going on is not really being felt. It's going to take some time to digest before you actually see the full effects of volatility. Another important thing to look at is the 10-year. So if you look at the 10-year, we did get a little relief yesterday, but overall, the bonds are still going up. And if you guys remember, when bonds go up, it's bad for stocks because it's competing with the stock market, because you can invest your money in the stock market and you see what's happening now in the stock market versus you get into a bond where you can get a guaranteed 4% interest without any risk. So those who really have the money would rather park it here. All right, so now let's talk about the sectors. So if you guys remember, there's 11 sectors in the stock market. Let me pull this up real quick. Ooh, let's see, 11 sectors. Wait. All right. Let's see. I think this is one we use. So some of these are going to be a little bit different depending on the year, but it's somewhat accurate. Let me see. I think this one's more accurate because technology is usually more around 20%. Hold on. All right, this one's better. So you guys see this? So technology makes up about 23% of the stock market, of the S&P 500. So whatever tech does is going to drag the market along because it's the heaviest. After tech, it's between healthcare and financials. So right now, healthcare is a little bit heavier than financials. You know what I mean? But so eventually you have to start looking at the market kind of like a body and kind of like what do you call it, like your different systems, the respiratory system, the skeletal system, the the lymphatic system. So you could say like financials are like the bones, like the skeletal system, because everything is built on financials. Every stock that goes public has to borrow money to go public or raise money to go public, and that's why financials, you could say, is like the bones that holds up the market in a way. But as far as the real flesh, and I would say that's technology. Tech is what really drives the market and moves along. So then after that, you could say healthcare. Healthcare is a very safe, strong, stable system that really anchors the market. And then after that, when you look at these other smaller sectors, other than industrials, you got energy, utility, real estate. These are small. They call them defensive sectors, D for defensive. So they don't really move the market that much. But for example, if you want to see the market go up, you actually want to see the smaller ones kind of go down or trade sideways, because now the smaller defensive ones are going up, and that means money is going into them that's being taken out of the other sectors. Anybody have any questions on what I just said? Everything clear?
I do. Can you repeat what you just said about the small sectors, how they?
Yeah. Yes. So the small sectors are, let me highlight, are these right here. You can see real estate, materials, utilities, and energy, right? So these are the defensive sectors. So these sectors, they don't move the market that much, right? But look at it like this, right? Now, if those sectors are doing really well and tech is doing bad, basically, a lot of times you'll see oil will do good a lot of times when the market does bad. Not all the time, but a lot of times. So now what that does is that when oil is doing well, more money is being pumped into that sector. When more money gets pumped into that sector, less money is being pumped into the other sectors. Does that make sense? So
Yes, it does. Thank you.
Yeah, so you don't want to see like if you're a bull, if you want the market to go up, that is right. You don't want to see all these defensive. So I'll write D for defensive. These are the defensive sectors. You don't want to see the defensive sectors doing well and going all the way up without the other ones going up as well, because all that is going to do is take money out of those sectors. But you're going to see too that let's say all the sectors are doing well, the little sectors doing well, it's just going to be like an extra boost for the whole market. So it's either going to add a little extra boost or it's going to take away some of its gusto. All right. So let me actually look at the charts to show you guys what I mean. So let's say, so I have a watch list called sectors, and I would recommend you guys do this too. So all the sectors have XL before them. XLE, that's energy. You see energy, this is the energy sector. And as you can see, energy, it's approaching the all-time highs, but if energy was past its all-time highs and going higher, that would have been bad for the market. Does that make sense to you guys? So energy is staying in line. Now we look at the other defensive, XLU. Look at XLU was down, that's good for the market. When XLU was up here, it was bad for the market. All right. Those are your defensive. Then other defenses, real estate. Look at real estate. Real estate has been plummeting ever, especially with the rise of the interest rates, and mostly that, I'll say, has really been plummeting the real estate. But since the defensive sector, we kind of wanted to stay the same. Wanted to like trade sideways or stay down, you know what I mean? But understand that if this goes down a lot, it still is downward pressure for the S&P. It's just not that big of a chunk, you know? Then XLC, so these are the defensive ones. You see, like, these are the defensive sectors, materials, XLB. But now when we come to the heavyweight sectors, we gotta look at XLK. Look at XLK. XLK, if you look at before, it was really falling down, but now XLK is starting to go up. This is the heaviest sector. So XLK, that's technology. That's all your Apple, your Microsoft, your Amazon. These are all your big tech companies, and they drag the market. So as this goes up, the market will also go up. So now what I want you to notice, right? This is XLK, right? This is technology. Look at another technology stock. You're gonna see how similar the charts are. So let's say you go look at Apple. AAPL, my phone. Wait, APL. Say you look at Apple. Look at how the chart looks the same. You guys see how it looks the same? This is Apple. This is XLK. You guys see how it's like the same chart? So you're gonna notice that, for example, XLE, this is energy. And one thing I was talking about in my video was, let me hide this real quick, is look at what all the oil stocks did as far as a structure. So does anybody know what structure this is right here? I'll even draw it out, give you guys a hint. Look. Anybody know what structure this is right here? Anybody? I guess nobody knows. So, no.
Could it be a double top?
More nuts. Maybe right here. You can call it double top right here. Yes, you can say that. But there's also something more significant right here. So maybe if it was like this, you would know. If it looked like if it was flipped upside down, would you know what structure this is right here? So this is a shoulder, right shoulder, left shoulder, right shoulder, head. So it's the head and shoulders. Head and shoulders is such a great candlestick formation. If you only learn how to trade head and shoulders, you can make a living off that alone. Because head and shoulders, when it plays out, it has about a 70 to 80% follow through rate. So this is a very strong reversal pattern. All right. So you gotta understand the way it works, right? Is so you guys know to know if something's going up, it has to make higher lows, right? So higher lows higher lows, and higher highs. You guys see that? How it's making higher highs and higher lows. You guys see that? So that's how you know you're on an uptrend. So understand that it makes a higher high, right? But then it fails to make another higher high, and that becomes a higher low. So now this becomes a reverse. So now what you do is you wait for it to come to this neckline, right? If it breaks the neckline to the downside, then most likely it's going to continue to going down. It may break, come back, retest this, and then shoot down. That's also very common. But it's all about the neckline because it might come to this neckline, never break, and just comes back up. So that neckline is a very important part. And as you can see right here, it broke the neckline, it came back, retested it, and now it's shooting up. You guys see that? Any questions? Is this clear to you guys? I want to make sure you guys understand.
I understand.
All right, so this is what you call an inverse, upside down, head and shoulders. And what you're gonna see that this is on the energy sector, which is gas and oil. So you look at, so like just like how I looked at Apple and technology sector, now I'm gonna look at energy sector and I'm gonna look at gas and oil stocks, and you're gonna see the same similar structure. So MRO is the one I played today, which is one of my favorite gas and oil stocks because it's pretty cheap. So let me type it in, MRO. So, hey, look at that. You guys see that? Left shoulder, head, right shoulder, neckline. You guys see that? Anybody have any questions? Anybody not see it? All right. So that's the point. Like, and then I can even go to a couple more, and you'll see similar things. Let me go to what's the other one? ExxonMobil. Another ExxonMobil. I'm not showing you that these are all different charts, guys, but look how similar they are. Because once you know the sector, it's like a cheat code for all the stocks that are in that sector. You guys follow me? So yeah, so that's basically the point I was making, is that follow the sectors, because based on how the sectors are doing, you're going to know what SPY is going to do, what the market is going to do. So for example, if XLK is up, XLF is up, and let's say XLV is up, then you know that, hold on, I don't have XLV on this list, XLV, then you know that the market is probably going to go up because those are the three heaviest ones. XLV. All right, but today I played energy because it's been a very strong sector all year. Like if you look at it on the larger time frame, the monthly, you see how strong it's been. If I go on the yearly time frame, you'll see that basically, if you want to know whether you can hold something for a long time, go to the yearly chart. So now you see that this year opened at the highs of last year. That's a very good sign that you could hold it. But if this didn't open near the highs or inside or below, then I probably wouldn't have held it. Like an example of a stock I wouldn't have held would have been like NEO. Because if you look at the yearly chart, look at the yearly chart on NEO. This year opened at the lows of last year. So I already knew that this year was not the year to hold NEO. Does that make sense to you guys? All right, cool. Now let's switch gears to Thinkorswim. Stop sharing this. Go to Thinkorswim. Is it open? Yeah, my Thinkorswim is open. All right. So let me share this with you guys right here. All right. So I made a YouTube video. Some of you guys might have seen it, and this is a trade that I took today. And I really liked this trade, the way I executed on it. So basically, you guys watched the video, but I bought 10 contracts at $3 on MRO. So that's only $30 invested, right? Then I sold 3 at 4, and I sold a couple more at 4, and then I sold a couple at 5. And I'm holding to 1 as a runner. So I was able to take about $12 in profit. Still holding to 1. Maybe I'll take an extra $2 or something. But basically, I'm holding this to see if it's a runner. and if it's going to continue. Now, why did I pick this and why did I get it at $3? Let me show you. So what is this? The October 28th $33 call, right? So if I go to $33 call October 28th and I go to the charts, but number 9. So I got a couple of things on this, not to confuse you guys, but let me go on the day. So look at this. So I seen where it came from, and I also seen where it could go. So I seen that, you know, last month this was in the 50s, even on the 10th, it was 47, came down to 28. And I see that it's just been getting beaten up. So these are my favorite options, is after they gotten beaten up and there's still some time left. So these options expire this Friday, but I have a couple of days, right? So now you see this moving every day, and you see that today it hit a low of 3. So yesterday it went, let me zoom in a little, closer on the, let me go to the hour, right? I'll go to half an hour so you can know where these things end. So you can see yesterday, it went up as high as $8, right? It came down to 6, you know, so me getting at 3, maybe sometime this week, this may be able to come back to 8. Depending on if oil runs, maybe you can go back to some of these previous numbers like 15 or 10. You know what I mean? I'm not thinking I'm going to be lucky enough for it to go back to 27 or 30 or 50. It's just that I know that things could bounce from where they are, and any little bounce is going to be a nice profit. Because what you guys got to understand is when you buy the contracts this cheap, it's very easy to double your money. You buy it for 3, you sell it for 6, you made 100%. Only question is how much contracts you buy, you know, and that's going to determine how much money you make. But at the end of the day, it's more about executing and taking profits. And that's why it's very important. Let's say like you want to get your trading together. One thing you want to do is just put a small amount of money and work on your discipline. Work on, when you see the profit, are you going to take it? You know, when you get the price, are you going to execute? Because that's more important than making money off one big trade, because you want to be able to be consistent so that every time you trade, you're following your plan and you're doing the same thing. You see profit, you're taking it. And what's so lovely is when I buy it at 3 and I sell it at 4, that's an easy 25% profit. So then when I sell it at 3, when I buy it at 3, sell it at 5, that's an easy 75-80% profit. And if I sell this last one at 6, that last one will be 100% profit. Any questions? Nobody has any questions? You guys follow me?
Yes, following.
All right, cool. So this is just a trade I made today, and one thing I do in the video is I use my demo account to actually go in early and see what happens, and then I adjust from there and I go in real life. But I let my demo be the crash test dummy. But at the same time, I get multiple contracts on both sides to watch the movements to see who has the advantage. All right. You guys have any questions? Anything you guys want me to go over?
Can you just explain what you were referring to when you said VIX? Because I wasn't familiar with that.
Oh, the VIX, yes. Let me go back to this. All right, so the VIX, I'll pull it up to go back to the daily. I'll go to the VIX. So the VIX is the volatility index. Do you know what volatility means?
Yes, I do.
Yep. So you already know volatility is a swing, the amount it swings up and down, right? The amount all the markets will swing. So now the VIX, the way it works, it's a ratio. It measures how many calls versus how many puts are in the market. When there's more puts than calls, the VIX goes up. When there's more calls than puts, the VIX goes down. So in that way, logically, right, when the market goes up, the VIX would go down because there's less puts in the market. But when the market goes down, the VIX goes up because there's more puts in the market. Does that make sense? Let me stop right there. Make sure you caught that.
No, because I was writing. So I wasn't writing that fast though.
All right.
So when you said when there's more calls than puts, what's happening?
All right. If there's more calls than puts, then things are going up. The market's going up.
Okay.
But if there's more puts than calls, usually this is usual. This is not all the time. But usually when there's more calls than puts, the market goes up. But then when there's more puts than calls, the market goes down. Because what this is the fear and greed gauge. It's measuring how much fear versus how much greed is in the market. When people are buying more puts, there's more fear. They're afraid things can go down. When there's more greed, they're hopeful. They're greedy, things can go up. Does that make sense?
Yes.
Yeah, so whatever the market does, the VIX does the opposite. It's usually. Does that make sense?
Yes.
Yeah, and the interesting thing about it is that it spikes. It spikes a lot throughout history. Like this spike right here, this was COVID. This is when the market dropped so much. So when the market crashed down, this crashed up. You know what I mean? Because there was so super fear in the market. But you'll notice every time it spikes, it always comes back to the average. Always comes back to the average. So now we're at a level where the VIX is somewhat high, elevated, but now it's starting to come back down again, which is going to give more greed and more certainty in the market, and the market is going to go up. But the weird thing is that this should have been lower than what it is right now, because if you compare, because these are daily candles, every single candle represents a day, and you see that this closed higher than yesterday. Well, if the market closed higher than yesterday, this shouldn't have done the same thing. It's supposed to do the opposite. Does that make sense?
Yes.
So that's already showing you that there's some lagging effects in the market. People haven't digested everything. Certain things haven't hit yet. That's all that's telling you.
Okay.
All right, and this is, and if you want to trade this, you can't trade the VIX directly. You have to trade ETFs that track it, like this one right here, like UVXY. So UVXY, this, if you notice, it's similar to the VIX, but the numbers are smaller, and you know it's very similar to the VIX. So this is a way for you to trade the VIX, and it's very liquid. Sometimes when I feel SPY or the market is too expensive, I'll buy this because it's a little bit cheaper and it moves very quickly. So that's the VIX for you.
Okay.
UVXY. Yep, you can do UVXY, or there's another one called VXX. There's actually a couple of them, but these are the main two ones that I stick to. VXX, you see, it's the same thing, but these numbers are a little bit higher. This one moves. I'll say, like, when it has a big movement, it really pays well. And I say this one just pays for any type of little movement. So this one's a little bit more liquid. This one's a little bit less liquid. And liquidity is just about how easy it is to get in and out of the trade. So, like, let me look at the options so I can show you what I mean. So right here, let's say I want to trade the VIX, right? So I can go to UVXY. And I can look at these contracts, right? Let me close this. I can look at these contracts. So to know something is liquid, the numbers have to be tight. The tighter the numbers are, so I'm talking about the bid and the ask. So these numbers right here. This is the bid, this is the ask. For you guys that don't know, the bid is the price that buyers want to buy it for. The ask is the price that sellers want to sell it for. They got to agree and meet in the middle. So for example, you see this one's, they want to buy it for 25, buyers want to buy it for 25, sellers want to sell it for 28. So maybe in order for the transaction to go down, you gotta buy it at 26, or you gotta buy it at 27. You understand? Or better yet, this one, 16, 18, you know that right in the middle is gonna be 17. So usually the middle price is the price that actually the transaction goes down for. So now if you look at this option chain, you're gonna see most of these numbers are pretty close together. So you would call these liquid, right? But if you go to VXX, it's going to be a little bit further away. So right here, you see 29.42. It's a little bit further away. You see this one, 26. So when you see the bid and the ask is further away, that means that it's less liquid. That means that for you to get in and get out, you're going to have to sacrifice some of your price for you to get filled. Does that make sense? Make sense for you guys?
It makes sense.
Yep. So watch the VIX. So like I was saying, watch the VIX. Because this will tell you how much fear and how much greed is in the market. So right now, as it's going down, that means fear is starting to go down and greed is starting to come up. And you can see that in the actual market as right now, the market's actually breaking new highs as of recently and trying to come up again, especially from this day. I don't know if you guys see this big candle right here. This was CPI. So on CPI day, I was upset I didn't have money in my account to trade and I was traveling, but just on my demo, $140 somewhere in here, got entry down here, up here became 4,000. And people that I seen people that day that turned $100 turned to 8,000 off this candle. All right. So that goes to show that you don't need to trade every day. You just gotta wait for big events and then have your money on the side waiting, and then you can play these big events. So every CPI is when they announced the inflation. The inflation came in hot, that's why it dropped so much, but then it rallied so much because of other news, right? But anytime there's a CPI, anytime there's a FOMC, that's when they meet the Federal Reserve. They talk about how much it's going to raise the interest rate. So these are the events that move the market. And if you guys ever trade these days, the market will go down like crazy or go up like crazy. And that volatility is enough for you to make a lot of money off of shorter term options. So that's basically it, you guys. You guys interested in the recordings, they'll be on my coffee page, and tap in tomorrow as I do I'll do some on demand, some back testing, you know, where I could simulate live trading in front of you guys.
This, which is pretty much the same, right?
All right, cool.
All I gotta
Peace.
Thank
do-
you.
All right, take care, everybody. Happy trading. Happy
Thank you.
Monday. Bye.
Good night.
All right, thanks. I see you, Sauce. Thank you for hopping on. Peace.